Hello and welcome to the look ahead for Thursday, the 11th of January, with me, Fiona Cincotta, Senior Market Analyst at City Index. So on the earnings front, there are no major earnings that we'll be watching out for tomorrow. Don't forget that Friday is the start of Q4 earnings season in the US. That'll be kicking off with the banks. Here in the UK, we've got some trading updates from the likes of Marks and Spencer's, Tesco, Taylor Wimpey and Whitbread. Marks and Spencer and Tesco be particularly interesting because that's going to be relating to that key Christmas period to see how they've been holding up. We have had some data through from the BRC and from Barclaycard relating to debit and credit card, which showed that spending was actually, we saw weaker growth in spending than expected. And the BRC actually, when you take into account inflation, saw a fall in spending at British retailers. As far as the economic calendar is concerned, we've got the ECB economic bulletin. We've also got the main focus for tomorrow, and also the main focus for the week really will be US inflation data. So that's for December. So inflation is actually expected to tick a little bit higher, up to 3.2% from 3.1%. Core inflation, which just removes the more volatile items such as food and fuel, is expected to continue falling down to 3.8% from 4%. As we look towards the inflation data, let's just sort of think about where we are as far as this is concerned, and as far as Federal Reserve rate expectation cuts are concerned. If we remember at the end of last year, there really was this idea that the Federal Reserve was going to cut rates quite aggressively across 2024. However, the market's been having a little bit of a rethink as far as that's concerned. If we just have a look here at the CME Fed Watch Tool, this shows us that the rate cut expectation for March, the market is pricing in around a 65% probability of a rate cut in March. Now, this is down quite considerably from around 85% probability that was priced in mid-December. So I think if we get a hotter than expected inflation print, then obviously that could sort of revive or could continue fueling those expectations that the Federal Reserve will not cut as aggressively as the market had previously expected. And so we can just see the market then perhaps, reining in slightly those aggressive rate cut bets for 2024. Now that would have the impact of pulling stocks potentially a little bit lower whilst boosting the US dollar and weighing on gold. However, if we did see inflation come in cooler than expected, then we would perhaps expect to see that a revival of rate cut bets or slightly more aggressive rate cut expectations across the year. And that would see the stocks potentially push higher. We'd see a sort of a pullback in the US dollar and a rise potentially in gold. I think the big picture here is, though, unless it's a really hotter than expected inflation print, I think, the idea that disinflation is on course and that the inflation is cooling is pretty much something that we'll be looking at. We're not expecting to have a huge rebound in inflation at all, but a slight tick higher. That's what we did see in Europe as well. So it wouldn't be necessarily a massive surprise here in the US either. Let's just have a look at what this means for the markets. So first up, we'll be looking at euro US dollar. As I said, not only got the inflation print tomorrow, which is expected to be the main driver of this currency pair, you also do have that economic bulletin. Now, the euro US dollar, you can see it's been consolidating around that 109.50 level now for quite a few sessions. It's almost as if it's waiting for that next catalyst, which could well be the inflation data. Now, if we do have a cooler than expected inflation print, then we could see that pair rise above that, sort of meaningfully above 109.50, heading towards the 110 psychological level. level and the 111.80, which was where that December peak was. On the downside, if we do have a hotter than expected print, then we could see the euro US dollar test out that 108.90 level, which a breakdown there exposes the 200 SMA. Just taking a quick look here at gold. Now, as we can see, it failed at resistance there at 2088, and it's been falling down really steadily since across the last couple of weeks. In fact, it's just finding a little bit of support now on that rising trend line that dates back to October. And that's the support around that 2025, which is where we're trading at the moment. If we do see a breakdown below that level, that brings 2009 support into play. That's the October high. And a break below that again exposes the 200 SMA. So that 200 SMA is a theme that's sort of appearing across a lot of charts at the moment. On the upside, if that rising trend line support holds, then we'd be looking for a rise above the 20 SMA, which is at 2040 and on to 2052. And just finally, we will have a look at, just bear with me because the chart doesn't appear to have pulled up here. So here we go. There we go. On to the Dow Jones. Now, as we can see, we had that massive run up across the last couple of months of 2024, but that price has just really stalled. It's flatlined just below the that 37,000, just above the 37,000 level. So it's currently trading just supported by the 20 SMA, which is the 37,400. If we do sort of get, as I said, a cooler than expected print, then that could be the next catalyst that the Dow needs to push higher and break above 37,800, which was the high that we saw at the end of 2023. Above there, that brings 38,000 into play. If we do see a break below the 20 SMA, then that's going to bring that the 37,400. That will bring 37,200, which was the January low, into play, and then 37,000, the round number. So lots to be watching for tomorrow. That's all from me. Sorry, I've just realized I can't get my hearing on that. But if you liked what you've seen, then please press like and also follow for more videos like this. Have a good evening.